Okay, let's unpack this. Welcome back to the deep dive. Today we are digging into issue number 5, and we're looking at a month that really feels like it reset the entire board.
Right.
December 2025.
It really did. We're calling it the December watershed. And I think the simplest way to put it is the Santa rally that never came.
Right.
And this was, so much more than just a bad month for stocks. It felt like a symbolic moment where market folklore just died, completely crushed by institutional reality.
I mean, the Santa rally, that's a tradition that's been around for, what, 75 years?
75 years with a nearly 80% win rate. And it just failed. The S&P 500 managed a plus 0.1% gain. That's basically flat.
So when a pattern that strong just stops working, it tells you the fundamental rules of the game have changed. Why did the folklore finally die?
It really signals the end of what we've been calling the narrative-driven euphoria.
The hype.
Exactly, the hype. We are moving, and moving fast, into a new market regime, and it's not dominated by retail excitement or, holiday optimism. It's dominated by purely institutional flows, deep macro, and algorithmic execution.
Algorithms don't care about Christmas.
They do not.
Yeah.
The old patterns, which are often driven by, discretionary retail sentiment, predictable cash flows, they're just being overwhelmed now by these huge systematic forces. Think tax loss harvesting, rigid central bank positioning, things like that.
So the mission for this deep dive is to really shine a light on this shift, how the institutionalization of assets, especially crypto, is sort of killing off that classic retail FOMO that fueled the last, 5 years?
Precisely. And if we're moving into a world where only systematic data and advanced models dictate price, then the infrastructure that supports all that analysis has to evolve just as quickly.
Right.
Which brings us to some pretty major announcements in the source material that really confirm that this kind of professional architecture is now mandatory.
And the market demands that speed, that rigor. The material lays out some really serious infrastructure upgrades, plus the launch of a key program that's designed to meet this new reality.
Absolutely. The need for speed and stability, it's just non-negotiable when you're dealing with algorithmic trading.
Right.
We've actually completed a total infrastructure overhaul for both our major sites, nitrader.com and s9mag.com.
A complete migration.
A complete migration. We move them on to advanced servers, specifically optimized for low latency and high stability. I mean, when market moves are measured in milliseconds, your access to data can't be an afterthought. It has to be the foundation.
That really reinforces the whole message, doesn't it? The market is unforgiving and reliability is everything. And I see the magazine itself is evolving, too.
Yes. Issue number 5 is intentionally streamlined. It's under 60 pages.
Less fluff.
Exactly. The community asked for less fluff and more targeted, high-value, data-driven insights. But it's also important to stress that our commitment to global access is still central. All the previous issues, 1 through 4, are still instantly available in English, French, and Arabic.
Okay, now let's talk about the big one, the training aspect. The biggest structural news, which I think really reinforces this shift away from, just drawing lines on a chart, is the official launch of the InnoTrader Bootcamp.
It's officially live, and we have to be extremely clear on one thing for everyone listening.
What's that?
This is strictly not for beginners. The market is just too mature for the basics now. This bootcamp is designed for the serious, intermediate, and advanced trader.
Why so narrow? Isn't that a bit intimidating for a wider audience?
It's necessary. It's necessary because the institutional gap is widening so fast. This is an advanced track designed to bridge that chasm between retail assumptions and institutional reality.
So you're diving deep into things like
macroeconomics, understanding global monetary policy, quant trading principles, and high-precision algorithmic execution. These are the fields that were traditionally reserved for institutional desk traders. If you want to compete in 2026, you have to master them.
And for the people who have been a part of the community for a while, there's a discount structure to recognize that loyalty.
We always prioritize empowering the existing network. So the tiered structure is pretty straightforward. The first 100 users get a 30% discount. Our level 1 or level 2 owners get a 50% discount.
And the mentorship alumni.
They get a substantial 70% discount. I mean, these are the people who have already proven their dedication to advanced learning. This is all about equipping our core architects with the tools they need.
And looking forward, the source material points towards the InnoTrader store. That sounds like a big leap for the region. It's a massive development. We're actively building what will be the region's first specialized marketplace for quant and institutional-grade trading tools. It's going to be the central hub for the advanced tools and systems that professional traders rely on.
So the message is clear. 2026 is the year where professional architecture and hard data replace guesswork.
Exactly. It's about transitioning from being an observer to being an architect.
All right, let's dive straight into the raw data that shows this shift. This is where it gets really interesting, looking at the top gainers and losers in December across FX, crypto, and stocks, the real volatility extremes.
Looking at the extremes in December, you can see these clear narratives playing out. In FX, for instance, it was all driven by two things: disappointment from the Bank of Japan and this relentless commodity strength.
So starting with Forex, the theme was JPY weakness and a commodity surge. What were the big winners?
Well, the top gainers were the JPY crosses that were paired with commodity currencies. KD-JPY was up almost 3%, plus 2.88%. AUD-JPY was right behind it. Even GBP-JPY rose over 2.5%.
And the JPY weakness was because the market was expecting a more hawkish Bank of Japan.
Exactly. Traders had priced in a significant hawkish tilt. They were expecting a clear timeline for tightening policy, and when that just didn't materialize, the carry trade unwound violently in the other direction.
And on the commodity side, the CAD and the AUD, what was driving them?
Global demand for hard assets just stayed really robust through December. It was bolstered by surprisingly resilient manufacturing data globally and inflation expectations in key economies. So that really lifted the Canadian dollar tied to oil and the Aussie dollar tied to iron ore.
And the losers basically tell the same story in reverse. USD CAD dropped nearly 2%.
That's the evidence right there. The Canadian commodity surge was so strong it just overshadowed general US dollar weakness. It was a month defined by macro divergence, forcing traders to look beyond just the simple USD pairing.
So if macro was driving FX, then the crypto market gave us the purest signal of this institutional shift, just extreme divergence.
It really did. I mean, the gainers were purely narrative-driven. Things like white whale surging 200%.
A classic meme.
Classic meme pump. Low float social media hype. We also saw ZBT and ZEC gaining 67%. But these are high volatility, low liquidity spikes that professional capital just avoids.
But the losers illustrate this death of retail FOMO in a way that should be a huge warning sign. We saw altcoins just disintegrate.
This is the critical data point. OMOVAL dropped 98%, Melania collapsed 98% due to documented fraud, Move fell 97%. These aren't just dips, they are systemic collapses.
It's just liquidity exploitation.
Extreme exploitation. When institutional money enters a market, it demands two things: regulatory clarity and deep, robust liquidity. The entry of professional capital just sucks the oxygen out of these highly volatile speculative tokens.
And international stocks, we saw really binary results, especially in biotech. Just life-or-death trial outcomes.
Exactly. The biggest gainers, CPR up 371% and RADX up almost 150%, both surged on positive Phase 3 or Phase 2 trial results.
Which is the final hurdle.
It's the final hurdle before regulatory approval. Success there just unlocks massive future revenue projections instantly.
And on the flip side, the losers were a mirror image. MREO down 87%, RZLT also down 87%.
Failed Phase 3 trials. It signals the end of the drug's potential. And it just highlights a market that is ruthlessly punishing any kind of ambiguity. Investors are demanding clear, binary execution, and failure is met with immediate capital flight.
Okay, so let's move into market sentiment. The overall picture seems pretty fractured, which, as you said, is the hallmark of a genuine regime shift.
It is. We're moving from a unified bullishness to very selective positioning.
Let's start with Forex sentiment, which is rated a 3.5 out of 10. That's decidedly bearish.
Yeah.
But this seems counterintuitive because the US dollar index actually surged in December. Why the dollar strength?
Well, the USD strength was really driven by three things coming together. First, persistent U.S. economic dominance over Europe and Japan. Second, this aggressive unwinding of year-end carry trade risk.
So portfolio managers buying back the dollars they shorted?
Exactly, to lock in profits. And third, some flight to safety flows, especially after that hawkish Fed meeting. The tactical takeaway from all that is to overweight safe havens like the JPY and the Swiss franc and actively underweight the growth-sensitive currencies like the Aussie and the Kiwi dollar.
They're the most vulnerable.
They are the most vulnerable if January data confirms a broader global slowdown.
Okay, now for the big paradox of the month, crypto sentiment. Rated 6.5 out of 10, so neutral to bullish, but Bitcoin plunged 22% in December. Yet institutional inflows hit a record $4.2 billion. How do you square that?
That is the single most important data point that illustrates this whole institutionalization thesis. This divergence confirms it. Retail capitulation is meeting systematic institutional accumulation. The massive price drop flushed out the last of the leveraged retail speculators. Smart money sees this collapse not as a failure, but as an opportunity.
An opportunity to accumulate Bitcoin as a macro hedge.
And to use altcoins like Solana with its 7 to 8% staking yield as a kind of fixed income alternative. The collapse cleanses the leverage, and it paves the way for a healthier, more systematically driven 2026.
And the source material really highlights XRP's performance here.
Absolutely. XRP surged 53%. It attracted almost 900 million in ETF inflows, and it provided the regulatory gold standard template.
By settling with the SEC.
By settling with the SEC, it achieved the legal clarity that institutions require. This validated the whole asset class. So the takeaway is to position for the Q1 2026 ETF approval cycle, favoring those regulatory clear winners.
Okay, finally, stock sentiment. Rated 4.5 out of 10, so mixed neutral, but with this huge regional divide.
Japan is the undisputed outlier here. We rated it bullish at a 7.5 out of 10. The Nikkei surged almost 6% in December.
And that's because of its attractive valuation.
Attractive valuation, yeah. It sits at a moderate 15.2 times PE ratio. And it's also attracting institutional rotation because the Bank of Japan, while not super hawkish, is promising higher yields eventually.
And Europe is the opposite, bearish, at a 2.5 out of 10.
The MSCI Europe index fell over 3%. It's driven by persistent recession fears, especially in Germany, where manufacturing is just contracting significantly. Europe looks cheap at 11.8 times PE, but the immediate outlook is grim.
So this brings us to the mean reversion strategy. If the S&P 500 is trading at a premium 22.6 times PE and Europe and China are these deep discounts, that seems like a strategic trade.
It is. And to put that 22.6 times PE in perspective, the long-term historical average for the S&P is closer to 17.
That's expensive.
It's very expensive. This premium means current valuations demand perfect, accelerated earnings growth just to justify them. The strategic implication is to overweight the underpriced equities in Europe and China, the mean reversion trade, to capture that inevitable valuation catch-up.
So you're expecting a re-rating of international stocks.
If the Fed executes 3 or 4 cuts in 2026 and stabilizes global growth, international multiples should re-rate upwards by 25 to 35%. That offers far better risk-adjusted returns than just holding premium U.S. megacaps.
Okay, so let's connect all this market data to the bigger picture. December wasn't just volatile. It was really defined by these huge shifts in central bank policy and geopolitical risk.
Exactly. And those shifts fundamentally reset how you have to think about portfolio construction globally.
The single most critical event, the one that really killed the Santa rally, has to be the Fed's December 10th FOMC meeting.
Without a doubt. This meeting delivered what we're calling the third cut that signals the end.
Okay, break that down.
The Fed cut rates by 25 basis points, which was expected. That was the third cut of 2025. It confirmed the easing cycle, but, and this is the important part, the official communications implied that the easing was basically done.
Right, so the headlines were all dovish, focusing on the cut itself, but the sources point to this hidden hawkish pivot under the surface. What were the clues?
The hawkishness was revealed by 2 internal data points. First, and crucially, 3 FOMC members dissented from the cut.
3.
3. That's the highest number of dissents we've seen since 2019. It created the first visible severe fracture in the committee's consensus, sending a message. The pace of cuts is slowing way down.
And that led to this devastating market disconnect, because if the Fed is cutting, that should help risk assets, not hurt them.
That's the core mispricing. Markets had priced in 3 more cuts for 2026. But the Fed's own projections, the dot plot, implied only 1 more 25 basis point cut for all of 2026. So the message was stark. The Fed believes inflation is contained, the job is done, and the neutral rate is higher than markets think. This forces a valuation reckoning. The S&P 500, at that premium 22.6 times PE, now knows it can't rely on the central bank for support.
Then, 10 days later, on December 20th, we get this surprise announcement about the balance sheet runoff ending. This sounds like a reversal of quantitative tightening.
It was a major under-the-radar pivot, and it signaled real systemic fragility. The Fed announced they were resuming Treasury bill purchases at $40 billion a month.
So they're injecting liquidity again.
They're injecting liquidity, effectively ending the runoff policy. And this move was forced by acute stress under the surface in the repo market, the absolute plumbing of the financial system. It showed that the system is way more brittle than the booming stock market would have you believe.
Okay, let's shift to geopolitics. 2026 starts with this huge binary risk event, Trump's tariff endgame. A Supreme Court ruling is pending.
The stakes here for global trade are just immense. The market is currently pricing in about a 60% chance that the president's authority will be upheld. If that happens, you get a clarity rally.
Clarity rally.
Yeah, we'd anticipate a 3 to 5% equity rally as global trade just sort of adapts to the known rules. But if the authority collapses...
That's the pain trade.
That's the sharper pain trade. If
Yeah.
that authority collapses, you're looking at a sudden, sharp sell-off, probably 3 to 5%, a stronger dollar, and a big VIX expansion.
And speaking of the VIX, the source material highlighted this big disconnect between all this geopolitical risk and the market's complete complacency.
It's a major behavioral failure right now. The VIX has been hovering between 15 and 17, which is historically low, despite extreme risk factors. Taiwan, the Middle East, NATO, Russia tensions.
So what's the ultimate tail risk that the VIX is just ignoring?
The semiconductor supply chain,
The-
TSMC, they make over 50% of the world's advanced chips. Any military action targeting Taiwan would instantly paralyze the entire global tech sector.
A catastrophic decline.
You're talking a 20 to 30% decline in tech stocks, a collapse in global industrial production. The market is so used to buying the dip because the Fed always steps in. In this new regime, that complacency is extremely dangerous.
So the implication is you need hedges. Defense stocks, commodities, gold.
Exactly. They act as systematic tail risk insurance. You have to treat them as insurance premiums, not growth bets.
Okay, let's drill down into some of the micro-level shifts. NVIDIA's collapse in December was a real spectacle, down 13% even after beating earnings.
That was the moment fundamentals really reclaimed power over momentum. NVIDIA fell from a historic $5 trillion valuation because when you're trading at 90 times forward PE, execution has to be flawless, and the structural threat finally got priced in.
The threat being the hyperscalers developing their own custom silicon.
Precisely. You've got Alphabet, Meta, Amazon. They're all rapidly developing custom in-house AI chips. Google's TPU v6, for example. This vertical integration just erodes NVIDIA's pricing power and its market share dominance. The narrative has peaked.
And the flip side of that rotation was Alphabet's surge in December, up 14%.
It underscores that pivotal capital rotation. Investors are shifting capital away from the pure hardware suppliers like NVIDIA and into the deployment platforms. Alphabet internalized its AI infrastructure. They own the data and the customer relationship.
We also saw that spectacular precious metals surge in 2025. Gold up 66%, silver up 165%. This confirms metals are now a geopolitical asset.
It's a systematic tail risk insurance story, and it's amplified by central bank behavior. Record central bank accumulation over 900 tons globally signals de-dollarization and rising structural tension. Metals are pricing in risks that the S&P 500 is just ignoring.
And in crypto, the ETF explosion following the XRP victory really provided that institutional blueprint.
The XRP victory provided the exact template that was needed for institutional comfort. Get legal clarity, gain ETF approval, trigger the institutional rush. That unlocks the potential for over 120 pending ETF applications to funnel billions into altcoins in 2026.
And finally, Tesla's volatility. A huge rally in 2025, but then a pullback in December.
Narrative fatigue is real. Momentum is yielding to fundamental scrutiny. The December pullback forced focus back onto production delays, increasing competition, and those uncertain tariff rulings. Tesla now faces a show-me year.
Okay, so what does this all mean? Let's connect these macro forces directly to the asset price movements, the why behind the numbers.
Right. We need to show how the Fed's hawkishness and the rise of these institutional calendars are the root causes of what happened in December.
So let's start with Bitcoin. It fell 22% in December, ending the year down 7.7%. You call this the triple squeeze.
The triple squeeze. This wasn't retail panic. It was a systematic, calculated move driven by three distinct institutional forces.
Let's break down those three causes, starting with the most systematic one, tax loss harvesting.
Cause number one. Institutional tax loss harvesting. This accounts for about 40% of the move. It's purely a calendar-driven thing. Institutions that accumulated Bitcoin all year systematically sold large blocks in November and early December.
To lock in losses for tax purposes.
Exactly, to reduce their overall tax liability. And crucially, they buy those positions back after December 27th to reestablish their longs for 2026. It creates this predictable downward pressure wave that's completely non-discretionary.
So they were intentionally creating selling pressure to manage their balance sheets.
They were. Cause number 2 was the Fed's hawkish pivot disguised as dovish. That was about 35% of the move. The moment the market realized the central bank lifeline was shrinking, all risk assets, including crypto, became vulnerable.
And the final piece, the holiday liquidity squeeze.
That was cause number 3, about 25% of the move. Retail traders compounded the institutional sell-off by exiting their positions before the holiday low liquidity period. But the key insight is the paradox. Cumulative institutional capital inflows hit almost $117 billion despite the price drop.
The dip was systematic, not fundamental.
That's the signal, a complete transition from retail speculation to institutional allocation.
Yeah. Ethereum suffered even worse. It dropped 26.5% in December. Why did Ethereum get hit harder than Bitcoin?
It really reveals Ethereum's position as a secondary asset in the institutional framework. Cause number 1, which was about 45% of it, was competitive pressure from Bitcoin ETF dominance.
The flows just weren't there for ETH.
They weren't. Cumulative Bitcoin ETF flows were $57 billion. Ethereum's were less than $13 billion. Institutions treat Bitcoin as digital gold and Ethereum as a smart contract utility. They're not co-equal assets.
And the core value proposition of Ethereum, the staking yield, that seems to be losing its edge.
That leads to cause number 2. The smart contract risk premium is evaporating. That's 30% of the move. Ethereum's high valuation was based on high staking yields. But as ETF products integrate staking and that yield normalizes against, say, a 2-year treasury, the risk premium diminishes.
So institutions just prefer the stability of fixed income.
They do. And cause 3 was simply the macro sell-off hitting altcoins harder. Ethereum has a higher volatility profile, a higher beta, so when sentiment turned bearish, it just dropped harder than Bitcoin.
So the takeaway for your portfolio is that altcoins now need real growth narratives, not just retail hype.
They need institutional growth narratives, better staking integration, regulatory clarity, things like that.
Now, the NASDAQ slightly outperformed the S&P 500 in December, but the source material points out that it significantly underperformed the NQ100 index itself. That suggests some dangerous concentration risk.
The key here is definitely concentration risk, specifically within the Magnificent Seven. The NQ's slight outperformance was really misleading because the internal momentum was basically killed by single stock action.
And that single stock was NVIDIA.
Because one was NVIDIA's 13% decline, which killed momentum. That was 50% of the drag right there. Given NVIDIA's weight, its sharp reversal just exhausted the entire index's momentum.
And the second cause goes back to that valuation disconnect.
Yes. Cause 2 was Magnificent Seven concentration exhaustion. That was about 15% of it. Valuations were just stretched to unsustainable levels. Capital has to rotate out of the most expensive parts, like NVIDIA, and into perceived value, like Alphabet. The risk is just heavily concentrated in a few names.
So gold was the macro darling of 2025, up 66% year to date, but its December gain was a modest 6%. You call this the job is done signal. What does that mean?
It implies that the massive move has already happened. The fundamental drivers that caused the 2025 surge are largely priced in. Upside from here requires a new fundamental catastrophe.
What caused the rally to slow down?
Cause 1, the geopolitical risk premium is already priced. That's 60% of it. The rally was systematic insurance against nuclear escalation and Taiwan uncertainty. That premium has been paid.
And the real rate floor concept. How does that reduce gold's appeal?
That's cause number 2. The real rate floor is established, about 25%. The Fed's hawkish pivot means real interest rates are positive. Gold is a non-yielding asset, so its utility as an inflation hedge is diminished if the Fed is done cutting rates.
And was there an institutional calendar effect on gold, too?
Yes. Cause number 3 was year-end inventory liquidation, about 15%. Institutions were doing tax loss harvesting and general inventory management. The takeaway is that gold's primary job for 2025 is complete. Upside in 2026 requires a new catalyst.
Okay, so given all these systemic shifts, the death of seasonal patterns, institutionalization, concentration risk, How do professional traders actually adapt?
That's the critical question. And the Community Corner in issue number 5 provides some really concrete answers through validated technology and strategies.
We talked about the generative AI moat narrowing with the NVIDIA Alphabet rotation. How does that translate into a long-term investment strategy?
The shift is from hardware scarcity to platform dominance. The competitive edge isn't owning the fastest chips anymore. It's owning the user interface and the proprietary data.
So you favor the vertical integrators.
You have to favor the vertical integrators over the pure hardware providers. The primary value in 2026 shifts to companies that own that data moat.
And we saw how XRP's regulatory victory was the blueprint for institutional crypto adoption.
Exactly. It's no longer about decentralized ideals. It's about regulated acceptance. The template is clear. Legal clarity, ETF approval, institutional rush. This dramatically reduces the uncertainty discount and opens the floodgates for all those pending ETF applications.
Okay, let's talk about a professional trading strategy. The Treasury curve steepener trade. This is pretty sophisticated.
It is. The 2 to 10-year yield curve ended 2025 historically tight, which signals late-cycle economic fatigue, and that tightness creates an asymmetric opportunity for a steepener trade in 2026.
So walk us through the mechanics of that for listeners who might not be bond traders.
The strategy anticipates a significant growth slowdown, forcing the Fed into rapid rate cuts. So you short 2-year treasuries, betting that aggressive rate cuts will drop short-term yields.
And you go long 10-year treasuries at the same time.
Right. You long the 10-year, expecting less movement because it already prices in long-term inflation fears. The goal is 100 to 150 basis point spread expansion. It's a classic risk management trade for pros seeking positive returns while equities struggle.
Okay, let's dive into the Community Corner. The 2026 roadmap talks about this transition from being an observer to an architect.
It does. It's about a move toward becoming a global provider of architecture developers and data scientists, going beyond just simple analysis.
And let's look at the concrete systems that members have developed. First up, the InnoTrader System V2.
This is a systematic trading logic. The core idea is the alignment of 2 different time frames. The H4, the 4-hour chart, for robust trend confirmation, and the M15, the 15-minute chart, for precise execution timing.
So it stops you from taking a short-term trade against a major long-term trend. And how does it handle volatility?
It uses the average true range, or ATR, band for volatility-based entry and exit zones. It's a system that's really designed for survival, not just profitability.
And the second tool, the Dukascopy feature, that addresses the absolute need for institutional-grade data.
Data integrity is everything. This is a high-performance data pipeline built to fetch and export institutional-grade historical market data. It's essential because standard retail data just lacks the precision you need for rigorous backtesting.
What makes it institutional-grade?
The precision and the speed. It allows multi-threaded downloading, up to 32 parallel threads, and you can download data right down to every tick granularity, which is the highest level of precision you can get.
Okay, now, for what I think is the most crucial lesson in the whole issue, Enid Detective and the multi-MA alignment miss. You tested a classic retail strategy, and the results were brutal.
The hypothesis was classic retail folklore, that the perfect alignment of 5 exponential moving averages could capture institutional momentum. We built an expert advisor to backtest this on 72 assets and timeframes over 5 years.
And the result was 71 failures and 1 survivor. Why did almost everything fail?
They failed systematically.
Yeah.
The strategy just lacked sufficient volatility filtering, leading to massive losses against inevitable mean reversion swings. The myth that a simple universal MA strategy works everywhere was just unequivocally debunked by the data.
But there was one paradoxical survivor, gold on the 15-minute time frame.
That specific pairing, XA-USD M15, showed an explosive 5-year ROI of over 20,000%. It turned $10,000 into over $2 million.
I mean, that sounds like the holy grail every new trader is looking for. But the verdict section brings us back to the psychological reality.
Right. It showed that while it was mathematically profitable, the system was profoundly psychologically untradeable. It had a maximum drawdown of 41%.
A 41% drawdown.
And it experienced a devastating streak of 13 consecutive losses.
13 losses in a row.
Yeah. The key lesson here is that you would need over $250,000 in capital just to psychologically survive those drawdowns. If you can't survive the mental pressure of watching that much money vanish during one losing streak, the strategy is useless no matter what the final ROI is.
Okay, let's bring this all home for the trader. The key takeaways for navigating 2026 based on this watershed moment in December.
The strategic framework for 2026 is defined by the Fed's hawkish pivot, crypto's institutional transition, and the systematic repricing of geopolitical risk. 2026 will be a year where demanding earnings growth matters a lot more than easy liquidity.
So what's the immediate, actionable advice for our listener?
First, stop leveraging crypto. That era is over. Institutional dominance will lead to lower overall volatility. The strategic approach is to use larger position sizes for multi-year holds, but without leverage.
And for equity and macro traders facing a Fed that's not so accommodating.
Use macro signals as your primary guides, especially the Fed's projections and the Treasury curve. Tactically, trim your Q1 equity exposure and rotate capital toward dividend-paying value stocks. Remember that mean reversion trade favoring Europe and China?
And finally, these institutional flow patterns, they create a kind of predictability in crypto.
They do. Based on the tax calendar, you should expect 10 to 20% drawdowns from November through mid-December, driven by that systematic tax loss harvesting. And that's consistently followed by a rally in the late December-January accumulation phase as institutions reestablish their positions.
Okay, January 2026 is critical. There are 8 specific events that are going to shape the quarter. Let's run through them.
Number 1, Fed chair succession. Powell's term expires in May, so the next chair is usually named in January. Markets are pricing a high probability of a dovish choice, which would mean asymmetric upside in equities if it's confirmed.
Number 2, the Supreme Court tariff ruling. That's the other big binary event.
As we discussed, a 60% probability of the court upholding the authority. That could lead to an immediate 3 to 5% equity rally. The opposite outcome triggers a sharp sell-off.
Number 3, Q4 earnings season.
Kicks off mid-January. Earnings growth is expected to be 9 to 10% for the S&P 500. Companies have to decisively exceed that guidance, or they'll face significant multiple compression.
Number 4, Bitcoin and Ethereum ETF flow stability.
January flows will be the first real confirmation of these institutional adoption patterns. We need to verify that the massive buying continues.
Number 5, geopolitical risk crystallization.
The nuclear testing moratorium expires February 5th. That date, combined with any escalations regarding Taiwan or the Middle East, serves as a crystallizing event for tail risk.
The VIX is way too low right now. Number 6, China economic data.
Mid-January releases on industrial production will give us crucial context on global growth. Weak data will pressure commodities. Positive surprises would support risk assets.
Number 7, new crypto ETF approval decisions.
The SEC has deadlines for several alternative crypto ETFs in January. Approvals will expand institutional access and validate those altcoins as maturing assets.
And finally, number 8, VIX term structure normalization.
We expect volatility to spike from the current complacent 15 to 18 range to 22 to 25. This provides asymmetric hedging opportunities. You should use VIX products to purchase some inexpensive insurance right now.
Okay, so December 2025 really marked the end of an era. The failure of the Santa Rally wasn't an accident.
No, it was the seasonal folklore of the past 75 years being systematically dismantled by the cold reality of institutional dominance and higher for longer real rates. The journey from being an observer to a true financial architect is defined by your commitment to using institutional-grade logic, macroeconomics, and disciplined, data-driven analysis.
The path is set, the transition is happening, and the market demands rigorous scientific preparation. For those of you ready to make that transition and dive into the specific data that informed this whole discussion, we've made the source material instantly accessible.
Download our magazine for free, this issue and past issues, at .swa9mag.com, and state that the magazine is available on 3 languages on FRAR, and that it's a monthly release. In addition, a monthly podcast like this one discussing the magazine is published on our YouTube channel. If you are passionate about finance, follow our TikTok channel, Enai Trader Hub. And finally, if you seek for a pro-grade community of traders to exchange idea with and to learn trading in a scientific approach based on data and not on dreams and imagination, you can visit our website, nitrader.com, to learn more about us and how you can join our community.